But let's get back to corporate corner then. JK Cement, that's the first management on the show. The stock is up close to 25% in this year. In fact, Motilal Oswal, they reiterated their buy rating. They've raised their EPS and EBITDA estimates for the next two fiscals. Unchanged for FY25, but for FY26 and FY27, they have upgraded their estimates a little bit higher. Mr. Anuj Khandelwal, the business head at JK Cement, joins us on the show. Hi, Anuj. Good morning, and thanks a lot for joining in. Well, let's talk about demand first up. You know, the first quarter was marred because we had elections, there was a heat wave as well, and the monsoon season as well, normally impacts demand. But how do you see demand shaping up? There is talk of some production cuts, of demand being weaker than expected. So give us your estimate with regard to demand. How do you see things shaping up? And what does it mean in terms of volume growth for your company, JK Cement?
Good, Nigel. Firstly, many thanks for having me on this segment. You've rightly said, look, the last 6 months, it's been quite a flattish growth for the industry, but it was more or less anticipated given that we were coming off a very high base year. Last year was the pre-electoral demand, year for cement, if I might say so, where, in the first 6 months, the demand had grown by around 15% over the previous year. So this year was expected to be muted in terms of growth in the first 6 months, first due to elections and then intense monsoon, higher than normal. In the next 6 months or so, we are far more positive about how the demand will play out. Maybe we'll have let's say in the next 6 months, around 6 to 8% kind of a growth in demand versus H2 of last year. So in the whole year, it'll be around, let's say, 3 to 4% kind of a demand growth for industry. We as JK will try to beat the industry growth by a few percentage points.
All right. So the industry grows by 3 to 4%. What kind of a volume growth should we be looking at for JK Cement? I think in the past you were hinting at high single digits for FY25. Is that still on?
Yes, that is absolutely on. So if the industry grows by overall for the full year by 3 to 4%, given that we are in a way pegging the next 6 months to grow at, let's say, 6 to 8%. So hence, if the full year industry grows by 3 to 4%, we'll try to grow by, let's say, 7 to 8%.
7 to 8%.
And if the industry grows more, then of course our growth rates also will be higher. But tough to say. We really hope, as your guests in the previous segment said, that $100 billion might come to India. If some of it also makes way to infrastructure segment, of course, we'll be talking of bigger numbers.
All right. Let's talk about pricing then. Demand, you're sounding optimistic about a recovery and you'll outpace what the industry will do. What about pricing? Anuj, in the last 2 to 3 weeks, I've been flooded with information. Price hikes being taken, price hikes being rolled back, part of it getting absorbed, part of it getting rolled back. What's the current situation on pricing? Because pricing is at multi-month lows. In fact, I could say multi-year lows as well. When do you push through your first price increase? Start of October?
It's a difficult question, Nigel. Look, we need to understand how these 6 months have gone by. First an election and then an intense monsoon. So you are right, the prices are quite tepid to say the least. Difficult to forecast prices because it's dependent on many factors. But one thing, which will be a positive for the industry per se is that as H2 starts and the demand grows, the overall environment for the industry will be better. But pricing is something it's very difficult to forecast, and I better not hazard any guess on that.
Okay, let's try to focus on what you can do to make things better. I think trade is around 65% of your mix. And out of that, I think you have low teens contribution of the premium segment, which gives you better profitability, better pricing as well. So tell us, where is that number currently and where is it headed? Premium products as a percentage of trade sales.
Yes. So last year we were around, let's say, 12 to 13%. This year we want to end or the exit run rate to be at around 16 to 17%. And in the next year, try to take it to 18 to 20%. This is a segment where we focus a lot, not just because of profitability, but essentially the segment of individual home builders are growing more and more quality conscious as they are getting more aware. So the premium products which offers better quality to them and better features to them are something they are preferring a lot. So we have it's a priority initiative for us. This year we want to exit at around, let's say, 16-17%, and maybe next year touch 18 to 20%.
Got it. All right. So we've got pricing volumes out of the way. Let's talk about capacity. The last time we chatted, we knew that you all had a goal of 30 million tons in mind. Now you've upped that. You all are looking at 50 million tons. That's nearly doubling capacity in the next few years. And I understand that as a percentage of your market share, it should be roughly around 10, 11% or thereabouts. So tell us, this entire capacity addition that you're talking about, by when does it take place? What is the capex that you're looking at?
Great. So look, 1.5 years back, somewhere around November 2022 or so, we were at 16 million. Right now, we are at 24 million with 6 more million tons under construction, which will get commissioned by end of next calendar year. So let's say December 25 or so. That'll take us to 30 million. It would be like a doubling of capacity in 3 years' time. Beyond the 30 million, which is already announced expansion underway, what we are working on, which is yet to be firmed up and we are yet to take it to the board, is around, let's say, 6 to 7 odd million, which is pivoting around the Jaisalmer mines which we have. Then around 5 to 6 million around our south plant, because that plant is sold out and we want to expand and grow our market. And then post these two plants, when they get commissioned, then we'll of course turn back again to central India to see if we can put up one more line there. We have also acquired the Toshali Cements in the recent past, 6 to 7 months back. And we'll also try to see if we can work around an expansion around that unit. So while what I would say is that the 30 million ton, the plan is firmed up, it's under execution. The good thing for us is that we have plan laid out for 50 million tons, but we'll take it in a very systematic manner so that while we deliver the growth which the investors expect out of us, we also keep our financial prudence in place.
What about inorganic growth? That's where all the buzz is, right? All the excitement over there. You're not interested in inorganic. You're going to do this organically.
This you can't say because, we acquired Toshali Cements 6 months back.
That's too small. Anuj, that's too small. Toshali is very small, less than 500,000 tons. I mean, we're talking about bigger acquisitions. It could get you to that goal even faster. What's your take?
So on a serious note, look, our base plans are all on organic growth because we have the right limestone reserves to do the organic growth at a cheaper outlay. In organic growth, it always depends on opportunities, the competition, the valuation, etc. So it's very difficult to plan your capacity expansion basis that. None of the companies do. If you look at other companies, also they have a organic plan charted out. Inorganic growth is always a cherry on top. It will come when it comes, but our base plan is organic growth.
And I think as of now, you're expanding it around $60 per ton, right? Roughly.
Yeah. So look, if it's a brownfield expansion, it touches $60, $65. If it's a greenfield expansion, which might happen when we take up Jaisalmer, it'll be a bit more costlier. But yes, broadly that number is correct.
Since you're expanding at such a low capex, Motilal Oswal, they put out a note. They believe that your ROE and ROCE can move to 21% and 15% from around 16 and 11% as of now. You agree?
Though they are experts in numbers, I have not really, I can't really sign off on those numbers. But look, one thing which is there and which they are getting it right in their report is, yes, our capacity expansion happens at a lower rate. Secondly, we have a track record of evacuating that capacity fast. So if we were to maintain that track record, then the productivity of that capital comes in sooner. So that is something which we need to look out, evacuate our new capacities faster so that we can meet the targets which the report has set out for us.
Okay, all right. So that's what they are estimating, that your ROC and ROE will improve, and you pretty much indicate that you're looking at some cost saving measures as well. So run us through that. In the next 2 years, 150 to 200 rupees of cost savings by a whole host of measures, alternative fuel, you're looking at reducing the lead time as well. Do you think that's possible? And what would it mean for an EBITDA per ton? In the last few years, you've averaged between around 1,000 to around 1,100 odd. Give and take everything, highlight the cost saving that you're looking at and how much of it will flow through to an EBITDA per ton, because the pricing one still, is a little bit dicey, the cement pricing as of now.
Okay, so maybe let me take your second question first. Giving an absolute EBITDA per ton target is difficult for a couple of reasons. Firstly, we are going through a silent period right now. And secondly, as you rightly said, pricing is such a big determinant of EBITDA that many times EBITDA per ton is not controllable, right? So from whatever our level is, we'll try to improve the cost, which will show down to our bottom line by 150 rupees per ton or so. And you're right, all these initiatives are definitely practical, implementable. 50 rupee per ton will come from logistics costs, both through saving measures as well as lead distance reduction. We are amping up our green power. Last year it was 51%. Already Q1 it was at 57%. And to meet our sustainability goals, we want to take it to 75% in the next 3 to 4 years. We are progressing well in AFR journey, and our thermal substitution rate is high. So a slew of measures will lead to that 150 rupee per ton cost saving, which will help us be more and more competitive in the industry. Beyond that, also we have our initiatives planned out, which will happen in medium term. We've won coal mine auctions in central India in February. So once, of course, it will take time for that to materialize, but whenever it does, it will lead to even more cost savings.
Okay, Anuj, final question before we let you go. We'll talk about debt and, capex and all the next time you join in. But I want to ask you about the paint space, because suddenly, there's a lot of optimism out there. Initially, when you'll announce you're going to go into paint, the street didn't like it one bit. But now they have come to terms with it, and they believe that maybe it's a business that goes parallelly with cement business. You're currently doing, I think, around 60 crores on a quarterly basis. How do you see this scaling up in terms of revenues? And by when does it break even? FY26? I know you're heading the grey cement division, but if you could throw some color on how the paint division is shaping up as well.
Yeah, so fair disclaimer, I don't lead the paints business, but yes, it's shaping up really well. Last year, we did 153 crores of net sales. This year, the target is between 250 to 300 crores, so which means it'll be doubling in a year's time. Yes, it has. Look, we were always clear that it has massive synergies with our channel on the white cement and the putty business, and it is coming through. So right now, our focus more is on trying to grow the business, set up the business, grow the scale of the business. Like any new business, it'll make a few losses in the initial years, but as of now, the focus is on growing the top line per se. Also, just to reiterate the fact what I've told you in my previous interviews, we have a set budget which is there for the paint business from an investment and loss funding perspective, and we are tracking well against that budget. So it'll not be just growth and not looking at the bottom line at all. But yes, but still the break even will be a couple of years away, like it is there for any new business.
Okay, all right, Anuj, appreciate you joining in. As you said, you're in silent period, but post the results, we'll re-invite you. Then we can push you a little bit more on pricing, EBITDA per ton, as well as how the debt number is shaping up. Thanks a lot for joining in and filling us in with all of those details.